Hello guys, welcome to this evening's presentation. And so this is going to be a two-part video. We're going to cover today's recap, and we're also going to talk about TGIF type setups. And so what I'll do is I'll go through the presentation first, and then we're going to go through an evening recap. Now, before I go into the presentation, this is a reminder that I'm not trading tomorrow. I'm not doing any trades. I've had a very awesome week again this week, so I'm not looking to add any new entries or position sizing into my trades for this week. Okay, so I know there's news coming out tomorrow. I'm not really interested, but for those of you guys who are students on the Discord, what I'll advise you to do is go on the charts during the New York session and journal your ideas, journal what you think the market should be doing at the release, and see how the market reacts. Okay, so because you're not trading tomorrow, it does not necessarily mean that you don't do anything tomorrow. Alright, so you can still be active and you can still learn something from tomorrow's trading. But I'm not going to be going live. I'm not going to be doing any sort of live trading or anything. So I will not even, I don't think I will look at the charts at all tomorrow. So tomorrow is going to be a day where I will not be dropping any videos or content. I might not even make any commentaries on Discord. But then on Saturday and also Sunday, you're going to get 2 videos from me via presentation, and then on Sunday is going to be a presentation plus a weekly forecast. Alright, with that being said, let's get into today's video, and the topic for today's presentation is TGIF type setups. So I'm going to use a very blank chart. I don't have any notes written down that I can pull ideas from and use for the presentation. Like I've mentioned before, I prefer my presentation just me talking off my head, and that's where I give the most amount of value, if that makes sense. Okay, alright, so I'm going to use the pieces futures to communicate the information for the presentation. Now, the first thing we need to discuss, which I've talked about many times and you should all be aware of by now, is the weekly range. And in a bullish week, typically you're going to get, I'm sure I've talked about this multiple times, and I'm sure some of you guys who are listening to this right now, you're like, not again. And you just need to, this is just kind of like a reminder, okay, of the concept. In the bullish week, institutions will accumulate price below the opening price. That's where they do the accumulation. Then the algo will then expand the market to a premium, where the individuals who accumulated price down here can be counterparty liquidity and then distribute accumulated positions down here. And so that premium could come at an high time frame level. Oftentimes it's going to be an high time frame level. Again, this is a weekly candle, and then the market retraces back down and closes out for the week on Friday, and that's how you get your weekly candle low, and also this is how you get your weekly candle high. And this is a bullish week. Okay, this is where institutions have done their buying. This is where institutions have exited their move. So this is where you've got your open, high, low, close. For a bearish week, it's the same concept, but it's just inverted. Market opens up, market starts to run up, which is what we call market protraction. And this is to allow institutions to come in and accumulate short contracts or short positions. And then the algo starts to drive price. Now remember, price is not being driven lower because of buying or selling pressure. It's all artificially driven. Okay, so the market is going to drive up into a short-term premium to allow for institutional distribution, or accumulation of institutional distribution, and then the market starts to expand lower and lower and lower into a discount where there's going to be counterparty liquidity. And then the institutions will come in there and offset, distribute orders right there. And that's where you get the low for the week and the market closes. And so you have your high where institutions accumulated short positions. And then you also have your low where institutions distributed the accumulated short positions. And this is a bearish week. Now, what we focus on, or what I've been teaching, is learning how to buy very close to or below the opening price. Okay, so this has been our premise of discussion, and this is how we've been trading for a while. And this is what we call trading in sync with order flow, because the daily candles are going to be in alignment. You're going to see the most expansion in alignment with the weekly direction premise. Right, so if your anticipation for a weekly candle is bullish, you're going to see the daily candle sprint more bullish than bearish. If your anticipation for a weekly candle is bearish, you're going to see daily candle sprint more bearish versus bullish. Now, what is TGIF? Now, let's go back to the basics for our style of trading. Our style of trading is what I call time dependent. Okay, it is dependent on time. Why is it dependent on time? Because time gives context to our narratives. Okay, I'm going to repeat myself one more time. I know it makes sense. Time gives context to our narratives. Okay, now if we're distributing, or if we've expanded up into our premium and it's a Thursday New York session, okay, then I'm going to be looking for reasons why distribution should come into the marketplace. I'm going to try to be short to get myself in sync with institutional distribution at higher time frame premium. Okay, now the more important element of this style of trading is basically time dependent. Okay, and this is what we'll call TGIF trade. So TGIF simply means thank God it's Friday, and it's not my word. So alright, so thank God it's Friday. That's what TGIF stands for. And essentially, what you're doing with this style of trading is you're trading reversals against order flow at a specific time window for the week. Now, the question is, what's the time window? Your time window is Thursday, 7 a.m. Eastern to Friday, noon. Okay, so this is your time window where you look for these type of setups. So if you've had expansion during the week, okay, and this is only valid if you've seen significant expansion during the first 2/3 of the week, then most likely you rarely see weekly candles just keep on expanding and expanding. Now, sometimes you could get a TGIF trade on Thursday. So it does some on Thursday. The weekly candle looks something like this. It trades up into a premium, then retraces, and you got a TGIF type setup. Then on Friday, it completely blows through Thursday's high and continues running and closes like this, full solid closure on Friday. Even though this happened, there was still a chance for a TGIF type setup or a reversal type setup. So that does not negate the idea behind our TGIF type setup. Okay, what qualifies this is the time window element. That's what we're looking at as qualification for our setup, especially if we have seen expansion during the first portion of the week. Okay, so usually on Monday, Tuesday, going into Wednesday, if we've seen significant expansion in direction of a weekly order flow, then most likely at an item from premium, like a daily premium or even a 4-hour premium, we could get some reversal type setups that's to align with Thursday New York session going into Friday London close. Okay, so this is what we're looking for, and that's the definition of thank God it's Friday. Again, remember it's time dependent. So what I usually do is when it's Thursday, it's always on my card. Okay, so that's one of my protocol. One of my protocol is there any possibility for a TGIF type setup? And that's the question I'm looking to answer when I'm on the charts on Thursday. And there's a reason why I selected the USD CAD for our trade and not euro dollar or cable for our trade. And this is where we go into today's trading, and I will show you some charts and give some explanation. Now, if you look at dollar today, you would see we had massive retracement. You could say dollar was bullish, even though we took sells on the USD. You would see we had a massive retracement back up into buy sell liquidity. If you look at euro, you can see we had the massive decline down into that old daily trade value gap or volume imbalance. Excuse me. So that's an old daily volume imbalance. Right now, sell starts from previous day. If you go to cable, cable was not as weak as euro, but it was still somewhat weak until we got into New York close and we started to see some continuation on the upside, and we'll talk about this. The years of CAD, we remained bearish against all the other assets, and that's why I gave a swing target on years of CAD because of the narrative I already described to you guys, which I'll talk about. Then obviously finally we've got Aussie, which traded up into Argentine liquidity during our session, and then aggressively priced lower into this first off 1 hour trade value gap, bullish of the block, daily BPR. So let's go out, zoom out to the daily time frame, and you can see the daily BPR is right there. I think tomorrow we're going to take expansion through that liquidity, so that is on the cards. Alright, so let's talk about TGIF type setup. Now, let's zoom out and look at the weekly range on dollar. You can see this weekly candle is bearish, obviously. Now, obviously, the week is not closed. But the first thing I want you to look out for is this. What is this right here? This is a weekly rejection block. So we're going to make it a block line, and we're going to make it dashed. That's a weekly rejection block. Now let's go down to a lower time frame, and let's start to see the narrative build up. This is Thursday, so let me get rid of this. Get rid of the line so you're not confused. Alright, so this is a Thursday, this is Wednesday, this is Tuesday, and this is Monday. Monday we opened up with a volume balance, traded lower, extended higher, and Tuesday we saw a run above a short-term high into our premium, which is a 1 hour bear shell block. We tried to get a run up, which we missed, unfortunately. On Wednesday, we saw a run up into this inefficiency, and we called the shorts down into this low here. And also, we said the market should run below the short-term low there, which it did today. Now, after running below that short-term low, okay, guess what the market did next? Now, if you remember, and I'm currently uploading today's session. On the session, I mentioned us looking for this to decline down into this, and then possibly this. But you would have seen I was not really convinced of 101.30. Why? Because of the narrative so far this week. If we were to be bearish and see 101.30, we should not be trading deeper into premium. Well, why should we not be trading deeper into premium, Jane? Well, I want you to view the market this way. On Monday, we have sell-side liquidity. Tuesday, we have sell-side liquidity. Okay, Wednesday, we have sell-side liquidity. So we're just simply building up sell-side liquidity, building up sell-side liquidity. So all the manipulation has been done already between Monday and Wednesday. All right, you can see here, if you try to short here, you're stopped out. Any short, you're being punished. This run lower, if you try to short, you're stopped out. You try to short, you're stopped out. This run here, You try to short, you're slipped out. You try to short, you're slipped out. You try to short, you're slipped out. So the market is not giving shorts a chance to ride the move lower. So that to me means if we are going to run below a short-term low, which is this is a short-term low, and then also this, it should not return back into the range. It should spread its wing, because all of this run above a short-term high, it's all accumulation for shorts. That's the way I'm viewing the market. So every single time we run above a short-term high, I'm viewing that as institutions are selling into the rally. Okay, each time we run higher, they sell into it. Each time we run higher, just selling into it. Each time we run higher, just selling into it. Now look at where the shorts is coming off of. This block line here is not just random. It's a daily premium. Okay, so let's go out to a daily time frame, and you see what I'm talking about. The open of this bear shadow block. Now I'm not using this as a bear shadow block. I'm using this as a bear shadow block. Why? Because of the size. Look at the body of the candle. The body of this candle is small and inside the range of the body of this candle. So this is my bear shadow block, and not this one. Now if you take out the body and zoom it out of this daily bear shadow block, and then we go to lower time frame, you're going to see all the run up into premium was simply a run into that higher time frame premium. Okay, run up into premium, higher time frame premium, 1 2 3 4, trades a little bit slightly through, comes all the way back down. Today, see what we did today. We trade up into that perfectly, and I'm going to talk about this. So it seems like we're spending time building in orders, positions. Now in my mind, when I see this run lower and I see the market willing to aggressively reject, I'm thinking in my head, okay, there is some distribution going on here. Now this is also coupled with the fact that we have a weekly rejection block right here. See, this is a weekly rejection block. Look at the reactions there. Alright, spike down there, spike down there. So what do you think is going on here? There's massive distribution going on here. Okay, distribution in form of counterparty liquidity. So as the market gets down to the higher time frame level, institutions are offsetting shorts against pending longs in the marketplace. The market rallies, and then they're building up a premium. Then the market drops lower, acting like it wants to run for that source of liquidity, induces shorts, and then runs higher, and then institutions can then be counterparty distributors against any existing buy-sell liquidity, and then the market declines. The market runs up into premium one more time, taking out short-term buy-stops. Same play here is also the same play here, but on a fractal basis, and then the market runs for that weekly rejection block. And look at what the market did today. Now today we would have liked to see the market trade down here, not reject, but trade through on the closing basis, create sell-side inefficiencies, and then we would anticipate 101.30 being the general liquidity, but it did not. Instead, during New York session today, we saw the market run up into a deeper premium. So in my mind, I'm considering the possibility of a TGIF type setup. Okay, and what I'm looking for is this run higher is to clear a buy stop. Now I think we want to drop down into discount. What do we have at discount? This inefficiency, and then the slow here. So I was thinking for certain we're most likely gonna run the low, aggressive reject, and then maybe come and take up biceps with this. But trade down into that weekly rejection block coupled with a bullshit block, and you've seen the expansion higher. Now how do you trade this? Now what I would have done in this situation if I had no entries this week, or if I only trade on Tuesday and Wednesday and I did not make any profit today, what I would have done is I would have skipped New York session, because the narrative for New York session was bearish, and that does not align with my TGIF type setup. So again, because the market could easily run and clear out sell stops, and you're saying you want to be bullish, and you're trying to take a long here, and you just get stopped out. So the narrative for New York session was bearish. That was it, bearish because of the reaction inside this fair value gap. Market spikes through the fair value gap and then shows a willingness to want to respect the fair value gap and trade lower. So that's why we're looking for short dollar during New York session. Now the market trades down into the bull shuttle block, and look at what the market does. Now remember, I mentioned during the live session, again, the recording is going to be up on the folder, and I'm going to upload it to Discord. I mentioned in the live session, if we for any reason trade through our fair value gap, we should be running for buy side liquidity. That's what I mentioned. Now I said that does not make me bullish on dollar. That does not mean I'm not bullish on dollar. It's not violated anything yet. I'm only simply looking at the run as a run for stops, and that's a tradable move. You see, that's the key. Now when you see this is how you interpret price narratively. You identify start of London close. Okay, so this is your start of London close, end of London close. Now look what the market does during New York session. Trades down into discount, weekly rejection block, bull shuttle block on the 5-minute basis, runs higher. Now if you're not going long here, that's understandable. I would not be going long here. I will not be taking it long here. Okay, this is where I would go in long. Why would I be going long here? Remember that old inefficiency we're looking for the market to stay beneath. Well, we traded above the inefficiency. What does that make that inefficiency? A BPR. See, that is a BPR. Now we have a BPR first. We have a fair value gap here. Why don't we want to see the market trade down into this fair value gap? Because we have a smaller fair value gap here. Because this inefficiency is outside our breaker block. See? So, and this is the question a lot of you guys ask me. When I see two inefficiencies, which one do I go for, Jane? Well, you always want to go for the inefficiency that has another PD array in concert with that inefficiency. So here we have two. We have this inefficiency, and then we also have this inefficiency. So out of these two inefficiencies, which should be the more sensitive price action? This one. Why? First off, you have an old imbalance, which is now BPR. Secondly, you have a breaker block. This is not a breaker block. This is not a breaker block. This run lower starts from this candle. This wick, ignore the wick of the candle. So this should be ignored, and this is the highest up close candle, so that's our breaker. Lots of candle on the run on sell stuff. So now if you take out the body of the candle and extend it out, so you have fair value gap, BPR, breaker. That is a buy right there. That's your buy. If you're buying there, what are you seeking? You're seeking buy side liquidity. Remember, they're going to distribute orders, and if they're going to distribute orders, they're going to seek the opposing liquidity against order flow. Where is the opposing liquidity? Here, and then here. Now, why should the market run up here and not just run up into this liquidity and decline lower? Think. In this run lower, have we seen any run on buy stops? No. So we can assume that these are relatively equal highs. Okay? These are all relatively equal because we did not see this candle. Now, if this candle traded higher through this candle, then we're going to be looking at that as the liquidity we're seeking. But no, we have this and then this, but they're in very close proximity to each other, so that's going to be a pooling of buy side liquidity. So that's where you're aiming for during long close. Now, obviously, you can see the precise precision delivery we add into that daily bear shuttle block. Here once, here twice, here again, and then you've seen the decline. Is this decline random? It's not random. It's trading up into an item from premium. Okay, it's not a random decline. It all originated from the item from premium, which is that daily bear shuttle block. And obviously we have a 15-minute premium, which is an efficiency up here. And that's the narrative. Now, again, what qualifies this setup against order flow, which I typically don't advise. Okay, there are other ways you can trade against order flow. Sometimes near London session will trade against order flow, and then New York session we used to continue in line with order flow. But this is specific for a scalp or a day trade. Usually, I get this type of moves during long to close if I'm trading TGIF type setups. I think there was one time on Twitter where I was trading cable. I was trading GBP dollar, and during New York session, I bought GBP dollar, and then during long to close, I sold GBP dollar, and everyone was absolutely. And I had about 5 or 6 people DM me on Instagram, and they're trying to pay me money to learn what I did. And what I simply did was what I'm discussing with you guys. Right. So New York session, I'm looking for a continuation line with order flow. Long to close, depending on how the market shifted delivery, I'm looking for a reversal. So, all right. So let's go into Aussie, which is the trade I wanted to point out to you guys. So we have a drawn liquidity up here. All right. Now watch this. We ran above that daily high just a little bit. Now again, this is a shallow run liquidity. Today it's a new trading day. I believe we're going to see a deeper run on that liquidity. But just for the sake of our teaching, okay, we had a run on buy stop, which is a daily level. We had a run on this high here, this high here, this high here, this high there. The moment we break below here, what is your bias? Is your bias bullish or bearish? Think about what I just described as TGIF type setup. This is an eye time from premium, right? So we're going to anticipate some kind of distributions coming to the marketplace. Now, if this happened on Tuesday, it's not really impactful for a short. But this happened on a Thursday, the time window I gave you for a TGIF type setup. Now, remember what I did on the presentation? I said sometimes you'll get trades against order flow on Thursday, and then on Friday it will continue, and then if you're back testing, it looks like there's no TGIF type setup, but there was distribution in that weekly candlestick. You just are not aware because you saw Friday's candle trade through the decline from Thursday. But I'm showing you this, that on Thursdays you can get this type of move. If you don't get that type of move on Thursday, then you can absolutely do that on Friday. But again, it has to align with your market narrative, meaning your market structure. Are we at an item from premium where some kind of distribution coming to the marketplace? Can you identify a shift in structure? Can you identify a clear low resistance liquidity run objective? Those are all the confluences that needs to come together to form your trade idea or your buys. Now watch this. If you look at this low here during Asia, we have not taken out the low. We came very close to taking out the low there, but we've not taken out that low. So we have sell side liquidity here. Now look what rests below that sell side liquidity. An inefficiency. So we have sell side liquidity with an inefficiency that is high probability. So the moment the market breaks lower like this, what you do is you identify your premium to sell short off of. You have 1, 2, 3 breaker block. Look at this candle train up into the breaker block and selling lower. So the breaker block is no longer of concern to you. You're now concerned with this inefficiency and the breaker. So what you could do here is you can sell short at the breaker block, the body of this breaker block. Okay, this is a short to my last down candle prior to run higher. That's a breaker block. You can sell short there, or you can use institutional entry drill to sell short. If you're taking a sell there, where is your stop loss going to rest at? It's going to go above the eye of this candle because that's the candle that creates the inefficiency. Why are you not concerned with this as a bear short block? Because number one, if we trade back up into this as a bear short block, all the trap liquidity here is going to have a chance to mitigate. Okay, so all the trap liquidity from a buy stop from individuals who are trying to buy the marketplace above this short term high, they have a chance to mitigate their positions because right now their position is on the water. And what we're looking for is we're looking for a very quick run lower that will force them to either exit their position, and that creates sell side liquidity. Because if you exit a long order, that is a market execution to sell at a loss. That's what a stop loss is. So we're looking for a quick delivery down into the sell side liquidity. Now watch this. Okay, if we took this down to a lower time frame, which is the 5-minute chart. Now, questions: why are we going to take this down to a lower time frame, Jane? Well, because we are scalping. Okay, so the time frame you use for your execution and also your management is dependent on your trading profile. So meaning, I think this is the basics already covered on the course. All right. So if you're short-term trading, you're more concerned with 1 hour time frame for trade management. If you're day trading, you're more concerned with 15-minute time frame and sometimes 5-minute time frame for trade management. If you're scalping, oftentimes it's between the 5-minute time frame, 3-minute time frame, and sometimes a 1-minute time frame for trade management. So that's why we're going down into this, because we're looking to trade London close reversal profile. Now watch this. We have a short-term high up here. I know you're looking at the scan 6 wick and you're like, what is this? Ignore this. Again, remember, this is a gap in the market. This is a gap created by news. So ignore the wick of the candle. If you look through, you can see before we ran the short-term high, we had all these 3 down candles. So we start here. Now we also have a fair value gap. So your trade is going to look something like this. Entry inside the fair value gap. Stop goes above the fair value gap. Why is your stop going to go above the fair value gap? Well, if the market trades through the fair value gap, what else can you reference as a premium? Nothing. Can you reference this as a bearish block? No. Why? Because we trade up into it, we've seen displacement. Can you reference this as a propulsion block? No. Why? Because we trade up into it and we've seen displacement that propulsion block does. So we've referenced this PD array for short. We've referenced the propulsion block for short. The next premium we need to see sell side delivery come from is breaker, fair value gap. So this is your trade. What are you seeking for? You're looking for shorts here where we have sell side liquidity. Now watch this. We have a big figure number, 0.71 big figure number. What did I tell you about running big figure numbers? The market is going to do so in 10, 20 pips, and then 30 pips. Okay, so if we went 10 pips below that big figure number, what does that put us at in terms of liquidity? Here, just under the low right there. Okay, just under the low right there, that's where we have our liquidity. So this could be a trade setup for you. A quick to the one, risk to reward. The market gets down here. You don't need to be precise. You're looking for a bread and butter setup. You're not looking for precision. You're looking for consistency. Now, if you wanted to be precise, 20 pips below that before number, that's where the low for the day comes in on Aussie. And it's not just a random level. It's the PMI of that daily BPR. And if you go out to a 15-minute time frame basis, you can see okay, all of these down candles here. Market breaks structure. So upside, trades lower into the bullshit block, expands away, auto block, propulsion block, expansion. If you watch this range well, you can see this displacement starts from this candle, not this candle. This is where we break structure above this candle, but after we break structure, we don't see displacement until this forms. So this is our order block. So you have order block, 20 pips below, before number, PMI of a daily inefficiency. That is the precision. But I'm not saying you need to look for this. This is just a cherry on top. Okay? Alright, so for years a cat, I already explained on years a cat why it should be weak compared to the rest of the assets. And I told you guys to leave 10% on for that daily swing low there. So let me zoom out so you guys can see what I'm talking about. So that's a swing trade. So 1.3225 is the swing trade we're looking for the market to reach down into. So finally, after all this consolidation, we've left the range on the SDCAD. So I think we should start to see it spread its wings and reach for sell-side liquidity, most likely. Alright, so that wraps up the presentation for today. And I will not be active tomorrow until Saturday, where I'll do another presentation. If you have questions, just tag or add my name on Discord, and I will respond to your questions. So with that being said, you guys will have an awesome weekend. Another very awesome week for us. It's expected, and we'll see what next week gives us. Be safe.